on covered call basics and campaigning. This is part of a $200 class that we offer. Today, of course, is free, but we offer a covered call writing class for $199, and you get this class and another one on scanning for covered calls, as well as 2 one-on-one mentoring sessions. And so this is valuable information you'll get here today. And if you want to, if this speaks to you as to something that you want to really go after, because you might be in a situation with stock that you want to sell calls on and you need more hand holding in the process, then go to the website. We have it, Discover Options, and take a look at that. It's in the curriculum part, and you can just click and see the description, and away we go. But we'd love for you to test the waters a bit more with this. Presented material today is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. And so we begin today with an outline as to what we're going to cover. And Jim just put in the Prepared Mind Show. I should probably mention that as well before we get going. On the weekends, if you were to go to YouTube and put in and just search for a class, it's a channel called The Prepared Mind. That is the blog that I do on in a video, and we kick out a few reports on the S&P 500, a directional likelihood report, as well as a condor and butterfly timing report. But there's the link there on the right that you could click and go take a look at. And but we produce that every Sunday evening or so, as well as with Frank's text blog on our blog site. It provides you a lot of great information before the trading week ahead. Here's our outline for today, folks. Covered call basics. We'll look at covered writing basics using at the money, out of the money, and in the money covered calls. At the money covered call campaign study. I'll show you some results of doing a certain algorithm with a campaign writing of calls. Finally, a modulating covered call study, and we're going to compare the two and see how they stack up. All right, so we have a bit of a different take on covered call writing, and that comes down to the modulating part that I'll discuss in a little bit. But we've had, over the years, many customers of OptionVue who are long stock, and some of them are in text situations where they can't really, they've been advised by their accountants basically to not sell their stock, and so they have to hang on to it. Well, what to do? Okay, if you find yourself in a bear market, what should you do? If you don't want to get rid of the stock and you want to hold on to it, then this is definitely a strategy you should consider. If you're bullish, then it's also a strategy you should consider if you're bullish for the long term. Okay, so there's a few things we need to understand. First of all, and this is a critical point, covered call writing is definitely a bullish strategy with downside risk. Now, years and years ago, when I first started in this with OptionVue in 1998, there was and at the time he was very famous. Wade Cook was a very famous seminar provider. And he advocated covered call writing and naked put writing. And it almost sounded as if you could make money no matter what the market did. Because if you wrote calls, you had a big cushion, and there really wasn't emphasized strongly throughout the trading community at the time that this is a big bullish strategy. It is not a market neutral strategy at all. And some people kind of got a little bit misled a little bit there. So I wanted to make that very clear. This is a bullish strategy. When you go long the stock and sell calls, you're definitely bullish. Okay, don't mistake it for a neutral strategy. You can apply this strategy to stocks and also ETFs typically. Technically, you could probably do it in the in futures, although it certainly is not a strategy that's espoused in the world of futures options traders that much that I've witnessed. But when we talk about covered call writing, we're speaking primarily in terms of stock holdings. You can also do it with ETFs as well. Of course, spiders, and that would relate down to the Qs and the indexes. You could do this strategy with those as well, of course. Okay? Why would you do this? Here's two advantages, and that would be, one, to enhance your returns in the long run, and also, and this is most important, to reduce equity line volatility. And as you'll see here by the end, that you'll see that a covered call writing strategy can greatly reduce the volatility of your equity curve, of your equity line. As your equity line wanders around on your long stock holdings, covered call writing can greatly reduce the valleys and the peaks and valleys of your equity line as you make money, or even hopefully as you're losing money, it'll help cushion the the downward trend of your equity line then if you're selling covered calls. And so these are the two big reasons. Enhancing returns will occur if you incur bearish moments and seasons as well as bullish. When you factor in those bearish times, the covered call writing can indeed outperform just a buy and hold strategy. It just depends how bad those bearish moments are. We'll get to see that in certainly by the end here, you'll completely understand that. All right, so we're continuing on with the covered call writing basics, and what we have here is just a simple example to display this, and that is that if you have a certain stock, we'll call it XYZ stock, and it's $10 a share, and you purchase 100 shares, the capital that's due out of your pocket without margin is simply $1,000. Okay, very simple. It takes $1,000 to buy 100 shares at $10. Okay, and in OptionVue, we have a graphic analysis screen here that just pretty much shows you what intuitively we all know. And so I'm going to just point out here on the bottom, and I assume you can see my pencil flying around the screen with a little circle around it, I believe is what you'll see. But the x-axis represents the actual stock price. As the stock goes up, we move to the right. As the $10 stock goes down, we move to the left. Then on the y-axis, we have the percent yield. All right, and so if we're above the zero break-even line, we're making yield. If we're below the zero break-even line, well, we're incurring losses there, expressed in terms of the percent of that $1,000. Such that if the $10 stock goes up $1, okay, we could see then at that point we would have made $100 or 10% of our $1,000 investment. Pretty clear. All right, and then down here in the yield line, we can actually see that 10% showing up. So that's how to read these risk graphs. Many of you, I can see the names, and I know you're very much veterans in reading these risk graphs. So here's an example of selling a covered call. We have the calls here listed with 30 days to go. We have the call strikes listed here, 8, 9, $10 call strikes, 11, 12, 13, and 14. Okay, the $10 call strike is set at $1. That's the market price. And then the time premium for that is $1. Now we do cover the mechanics of options in another class, the Introduction to Options. That's a simple $99 class. You meet with Ken Dole, and he'll walk you through all the basics if you have questions. And so that's another class we offer where we go into extrinsic and intrinsic value. But there's $1 of time premium here. And if you were to sell this call for $1, each contract controls 100 shares. So a $1 per contract collected times 100 shares means that you will collect $100. Okay, then what's the net amount required from you? It's $1,000 minus the 100 you collected. The net requirement out of your pocket then is $900. So that changes the yield a little bit. Now that you're coming in with less money slightly and you make returns, it enhances the returns on the capital required. So here's the risk graph of that covered call writing position. All right, so you have the buy, just simply the stock is in blue here that we just looked at. If we sell a $10 strike option for $1, we're collecting that $100 that you see here, and that's the distance from the zero break-even intersection of the long stock all the way up to here. All right, so if we're collecting that $100, then the risk occurs when the stock declines more than that premium collected. Coming down here, $9. So we're collecting that one. So our then break even is that $10 minus that one we collected, and there we are, down at that $9 mark. That is, so the stock would have to go down in 30 days past $9 for us to lose money. And this is as of expiration, of course. Now, our gain is limited, and this is very important that we understand. If the stock price rises past the stock price, past the strike price of the covered call, our gain is limited. Now, here we sold an at-the-money $10. Our gain is limited from $10 on out, and it's limited to that $100. You can see down here, we're not going to make any more than that $100 no matter how far the stock goes up. It could go to $12, $13, or $14. Our gain is limited to that 100. That's important to understand. Okay? Now, the marginal gain intersection is defined as the strike price plus the premium collected. $10 plus the 1 puts us at 11, and that's where that intersection is. So if it rises above 11, well, then it would have behooved us to have just held on to the stock without writing a call. If it's short of 11, okay, if it's short of 11, a 10% gain in 30 days, if it's short of that, then you could see the red line here is above the blue, and indeed that area is an area where it would be better to write the covered call, and anything above that intersection is over here. It would be better to just hold on to the stock and not write the call. Okay? So, that explains that a little bit. Now, I want to talk about doing something other than just selling the at-the-money call here. And a lot of the covered call writers, they just go right at the money because that's where the fattest time premium is, the at-the-money calls. And that, there's merit in that. If you're going to sell options, you want to collect some time premium and make it meaningful. Now, but I want to point something out here, and that is that selling out-of-the-money calls allows for greater upside returns. Greater upside returns. And this is important because if you have to hold on to your stock, and you can't, and maybe you have to, you're long-term bullish, but you're undergoing a little pullback period, and then it all of a sudden turns up, and now you're super bullish. Well, you may want to then push it out a little bit. And here I want to point out, if you go to the at 11 strike, you collect 62 cents of premium. All right, you're collecting $62. Your net amount still goes down to $938. It's not all the way down to $900, but $938. Now, when you analyze this, look what happens. Okay, instead of making that 10%, now you're able to make 17% on your money. We're going all the way out to this 11. So anything past the 11 is where it's limited. Before, remember where it was? It was down here at the 10 mark, right about there, and it was cut across the screen right there. Okay, so well, it kind of came up here and then did a jig there. Well, no, it started here and ran straight across. Here it's starting at the 11. So as much as the market wants to go up, we're going to incur all that gain all the way to 11 at the same pace as the broad market, as the stock, and then that's where we cut out, and our gain is limited. And then the intersection is way out here, way past 1150, where it would have been better for us to hold on to the stock. So the farther out you go in the options, out of the money in the calls and sell, then that's giving you more upside. Now, when would you want to do that? Well, when you're super bullish. You want to do covered call writing when you're bullish. And if there's a season where you're super bullish, sell that call that's farther out of the money then. Okay? Now, let's look at the other way. Why would you ever want to sell in the money options? In the money calls? Well, selling in the money calls allows for greater downside protection. Greater downside protection. So in this case, let's go 10% in the money to the 9 calls. We're collecting $1.53, 53 cents in time premium. And that time premium represents the yield if the stock is above the strike price when the option expires. So we're going to go down here, sell it for $1.53. Now watch this. When we analyze this, we're gaining a tremendous amount of cushion then. Look at this. The stock can still go up, and we make money, same as the stock move, all the way out to the 53 cents coming out here. I believe that's where that intersection is. But look at this downside. Look at this. The market can go, the stock can go all the way down to 850 about, a little bit more it looks like. And it can go all the way down there and we still won't lose any money. In fact, it can go down to $9 and we still make 6% on that money. Isn't that something? It could go down 10% here. It could go down 10% and even more, and it could go down 10% to $9, and we're still making 6% on our money there. Now, when would you want to do this? Well, you would want to implement an in-the-money call writing strategy when you're not as bearish, or excuse me, not as bullish on the stock as perhaps you were when you were selling out of the money options. Maybe you know you need a lot more cushion. Maybe we're entering a season where the broad overall stock market is getting bearish. And here you might have to, you're in a position where you have to own the stock perhaps because of your accountant's advice. Well, now you could sell in the money options and still make some decent yield in 30 days and giving yourself some good cushion. Now this is fat premium, about an 80% or more implied volatility. And I did that to make a point. But so there it is. You have 3 scenarios of selling premium at, in, and out of the money. And so we're going to kind of combine those into one cohesive strategy here. So should a long-term stock investor sell covered calls? I would contend yes. Long-term being key here. Longer term. If you're a short-term swing trader, if you're a day trader, certainly not, but you want to be out there, certainly several weeks, if not a lot more, to implement this strategy. If so, should you sell at the money calls only, or should you modulate from at the money to in the money to out of the money, depending on market conditions? And that's what I want to go after now, is we're going to do some comparison in campaigns. So here I'm showing you a season of the Qs. This is a study I started way back in 2009. Basically, it's when we started this up. And what I'm going to do is show you a comparison of holding the stock, in this case the Qs, holding the Qs versus selling just at the money calls versus modulating the covered calls. All right, and I'm going to take 3 different swaths of time. All right. I'm going to look at this swath, for lack of a better word, and it's something my English major wife would be proud of me for finding that word. We have a thing going where she comes up with goofy words that probably are out of context, but she's just trying to throw it past me, and so there you go. You take a look at this. Remember the crash of 2008? Brutal, completely brutal. And so we're going to look at what the buy and hold would have been here versus modulating versus just selling at the money. So here is your yield level. If you had purchased the Qs January of 2007 through December of '08, a two-year hold period. Now we're going to get to something more recent here. I'm going to take a bit of time, in this decade, and at the beginning of this decade, and then most recently. Okay, so I just want to point this out to you. Had you gone long the Qs here, January 2nd of '07, it would have gone to about a 25% yield there near about November of '07 or so, and then it began to come down. Came all the way down until we were break even then in the spring of '08. It rebounded up, went to 15% or so, came down and rallied until we had about a 10% total yield. Then the wheels came off, of course, when the crash occurred in '08, in the fall of '08. And it went all the way down such that if you had held onto it at that point, you would have at a certain level then been at a 40% loss on your investment from back in January of '07. Okay? Very dramatic, very brutal at the time, of course, those of us that were around and watching all this. So here's a strategy. We're going to take those Qs, we're going to sell at the money calls, in this case 500 versus then selling 5 at the money calls. We're always going to put it in the first month with over 21 days remaining. And of course, any strategy you apply here, if it trades weeklies, you can go out and do weeklies if you want, although typically the covered call writing is more of a long-term strategy. So we're just keeping it to the months right now. And we're going to hold on to that call until there's 20 cents or less at the close. Now, I kind of bent it from the close. I'd back it up a little bit. Sometimes I'd go to the close and there'd be 5 cents or 10 cents sitting there. Well, and I knew in the day that it was actually much, it probably hit 20 cents during the day. So I did kind of back it up to try and get that 20 cents as best I could. And the reason there is that we just don't want it to get called away. If there's still 20 cents time premium sitting in there, there's a good chance it's not going to, it's very probable it's not going to get called away. And so that's why when you hit 20 cents, go ahead and then pull the trigger and roll that thing and increase the time premium that you're bringing in. Here's an example. Okay, we have the Qs. We're sitting here with 11 days remaining in these calls that we wrote, and the time premium in those calls is now down to 18 cents. It's now time to buy these back and sell another call option. Now, if February had more time in it, let's say February had like 25 days remaining, well, then we would roll it up and we would find an option here that had at least 40 cents sitting in it. Okay, and that's kind of what we're looking for, and I'll get into that rule under the modulating. But we're looking for at least 40 cents or more. We get out when we're at 20 cents or less. All right, and it shouldn't be too easy. So we're going to then, it shouldn't be too hard. So then in this case, we're going to roll it over to the next month with 39 days remaining. We go to the at the money call. Stock's at 44. Here's the 44 strike. There's $1.02 of time premium in that price. And so then that's the covered call that we implement right there. We sell 5 of those. So we're rolling then it to the next month. Okay? Now, we roll it to the next month, and away we go, and we just simply watch this time premium. Day by day by day, we watch to see how much time premium there is, and when that gets to 20 cents or less, we then buy that back, and then we roll it to the next month, unless there's more than 21 days here, and then we stay in the same month and roll it up or down to the next option that has over 40 cents of premium. Okie dokie. All right, here are the results. And this is, I'm making it clear, this is all hypothetical, and past results are not necessarily indicative of future performance, all that stuff, etc. This is not from real trading. In OptionVue, we can create the the transaction log and see everything going on here. And in this case, I've thrown some out to you from '07, just showing you that we have the whole campaign. And I am using commissions here, some fairly fat commissions. The originations of this study came from back when there was an options trading magazine, and Jim Graham and I would every month produce a study, a meaningful study of backtesting to then get published in that magazine. And they wanted some pretty fat commissions included. So this does include commissions, although the slippage is set to none, and we're getting right between bid and ask on that. So we are accounting for some of the slippage in the form of fat commissions. So here is the equity curve of the buy and hold in blue versus the at-the-money covered call writing campaign. So I want to point out to you that as the market, as the Qs began going up and incurred a 10% gain, then a 20% gain, then a 25% gain, selling at-the-money calls meant that you were limited to the premium that you were bringing in, and it really limited the upside to your strategy there. And so whereas the buy and hold was up at 25, our covered call writing campaign was up to about 15. Now, look at the volatility of that purple line up to that point. Just look at that. The blue line is making some wild gyrations on its way to 25%. But can you see the purple line is kind of just chugging its way up at a rate that has much lower volatility levels. And this is one of the big draws on using option overlays. And Steve Papali, one of our mentors, is a specialist at creating these covered call writing overlays for long-term holdings. This is really his specialty. And if you were to enroll in our $199 covered call writing class, you would speak with Steve for a couple hours, and he would help you implement this strategy with your own situation as it relates to the models that we present here. Okay, now, then the wheels start coming off. The wheels start coming off. It goes from the buy and hold goes from 25 down to -5, whereas the covered call writing takes it from +15 down to about -3. See that? And so it cushioned the blow dramatically. Cushioned the blow dramatically. Now what could have been done is if you were really, really bullish up to here, and then when you had this crash happen there at the beginning, you could have said, you know, I'm going to implement a covered call writing campaign during this bearish season, and then this would have cushioned the blow dramatically coming down. But then what happens after that? The market rallies, and of course the buy and hold outperforms the at the money. Then the covered call writing cushions the blow of this down blast that really hits the buy and hold hard. And then of course in the crash, you see the two were right even there. And then at the end of the day, through '08, the buy and hold was down here at -31, and the at the money covered call writing campaign was at -14 for the whole 2-year period. So the losing yield was less than half as what it was for just the buy and hold. That's a great example of the power of doing a covered call writing campaign in the face of bearish activity. It really cushions the blow a lot, as you can see there. All right, now let's talk about the modulating covered call approach. Instead of rolling to an at-the-money call at all times, let's now consider selling out of the money calls, going out 5%, selling calls 5% out of the money when the market is trending upward. And then when the market is trending downward, we'll sell in the money options, in the money calls, 5% in the money when the market is trending downward. And then if the market is undecided, we'll stick with our at the money options. So we're going to modulate it between at the money. If we're really bullish, we're out of the money. If it's trending upward, we're going to sell out of the money. If it's trending downward, we sell in the money. Okay? Now, how are we going to decide if the market is trending up, down, or wobbling in the middle and undecided? So I'm going to show you this 250-day simple moving average system that determines these three zones. A zone for uptrend, a zone for downtrend, and a zone for undecided. And again, we want at least 40 cents premium when we go deep out of the money or in the money. Here is the three-zone system that I just expressed. We throw on a 200-day moving average, that's the blue line. We throw on a 50-day simple moving average, that's the red line. And when price is above both moving averages, and we find ourselves having to roll at that point, if we find ourselves having to roll because it got to 20 cents or less on time premium, we go look at the chart and examine and find out which zone we're in. If we're above both moving averages, that means we're trending upward. We're going to sell out of the money options, out of the money calls. If we look up and price is in between the two moving averages, that's when we're going to sell at the money calls. And if we look up and the price is underneath both moving averages, that's when we will then sell in the money calls to cushion the blow then of any further down blast. Okay? So, three zones to determine if we sell out of the money, at the money, or in the money calls. Let's look at, okay, and here's the, let's see, what is it? What did I do this for? Let me go look. Oh, this is just an example. This is just an example from September 4th. The market has gone down. We're underneath both moving averages. Okay, it's time to roll. And we look up, time premium here is down to 8 cents. We're going to go ahead and buy those back. And we're going to roll it then to the next month because there's only 16 days here. We're going to roll it to the next month. And because we're beneath both moving averages like this, we're going to look here and determine to sell an in-the-money call. Okay, we're going to go 5% in the money, sell that, and that's bringing in 78 cents of time premium. We're going 5% in the money to that in-the-money strike. When we analyze it, oh, we didn't analyze, but that's just a simple example. Next is the results of doing this. I showed you the buy and hold in blue. I showed you the at the money campaign in purple. The modulating covered call approach. Look at this. Way up there, we're pretty much even. Just right at break even there. And the most we were ever down was 10%. And this is a 2-year period where we had some sharp downturns. And I want to point out to you, when this market really began to go down harshly here, that's when the green, the modulating, really kicked in and had much less volatility there on that down move. And it actually ended up then outperforming the other two from then on as this bear market kicked in by selling in the money calls during some of these bearish periods. You could see that the green ended up being the big performer here, as would be expected when the market goes down, 40% in a 2-year period. It's a great example there. Now, I want to show you also 2 different periods of time. Oh, and I'm carving it up. This is carved up between 2007 and 2008. That's just another way to break it down. In 2007, before the real crash occurred, the buy and hold was, of course, the best. Modulating outperformed the at the money by just a little bit. In the crashing year of 2008, the Qs crashed huge for almost 42%. The at the money almost down 22%. The modulating down less than half that. Not bad at all. At the end of the day, our annualized return, we're pretty much breaking it just down even just 0.1% on the modulating. So those are kind of breaking that out, what I just showed you there. Now, let's take another look at a period of time. Let's look at October 11 through 2012, or through most of 2012. A one-year period, 11 to 12 here. Now, this is a bullish season, going from roughly 55-ish up to 70. Pretty strong bullish period with a good pullback season in there. How did the three approaches fare at that point? And here it is. Big bullish season. It's no surprise that the buy and hold in blue did the best. The modulating approach, though, outperformed the at the money, which is interesting. And that's kind of one of the points here, is that the modulating in a bullish season like that still outperforms just doing at the money, because you're giving the market room to breathe then. In a big bullish season, you're selling out of the money calls instead of at the money. You're giving the market more room to breathe on the upside, and you're going to incur those gains. So that's why a modulating approach is probably better. Certainly, I think just in general, modulating it is better than just going constant at the monies. Here's another period of time. We're going to go October 14 through May of this year. Okay, this was more choppy, very, very choppy. But we're starting about here, and then it kind of goes down pretty much. Well, seeing is this was intermonth right here, and I'm taking data points at the end of each month, going all the way through. But it went basically from 98, 99 up to about 106, something like that at the end of the day, with a lot of choppiness in the middle. Here is what happened. The modulating is in purple, and the blue line is the buy and hold, and you can clearly see the blue line is extremely volatile with all the choppiness going on. The blue line, or excuse me, the purple modulating line performs better than the green at the money line for most of the time. And of course, at the end of the day, with that big blast off, that's when it really took off, and that the buy and hold then ended up outperforming the covered call writing. But again, the point here I want to make is, if you do covered call writing, the modulating approach is a better way to go than the at the money, just constantly doing at the money. The modulating outperforms in all three scenarios that we looked at here today. And that's kind of the lesson, is that there's great advantages to covered call writing, and if you do it with some long-term holdings and you're going to campaign, you want to use a modulating approach. And I would consider using the three-zone approach that I just showed you, using 50 and 200. Of course, you can come up with your own other zone approach to determine trend, uptrend, or undecided. But any questions, comments? Love to hear from you. Love for you to consider, those of you that want to pursue this and speak with a professional options overlay individual. Steve Papali is our main guy for that, and he's had some custom overlays, and he's been a consultant for folks that like to do custom overlay design for their holdings. That's kind of what he does. All right, PJ. Hey, great to see you, PJ. Yeah, get in touch here. That'd be great. Okay. Well, no one else is typing in. No other questions. Folks, thanks so much for joining us. I appreciate you joining us for this class. And keep looking in your emails for future classes. We'll do some of these free classes during the middle of the week. And don't forget the Prepared Mind on the weekends, Sunday nights at the YouTube channel, The Prepared Mind. Thanks a lot. Take care. Have a great rest of the week. Bye-bye. Oh, yeah, Facebook page. Go to that Facebook page Jim just pointed out. There you go, and click that link on the right, and love for you to like us. Take care. Bye-bye.